Hey everyone, today we're taking a deep dive into Lyft stock, its performance over the past year, and why many investors see this as an interesting combination of value and growth. We'll break down recent numbers, explore rider trends, analyze financials, and discuss strategic moves like share buybacks and autonomous vehicle plans. If you're curious about what's happening with Lyft and whether this ride-sharing giant has long-term upside, stay tuned because we're going to cover it all. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. So let's start right at the top: Lyft's stock price and how things have been moving lately. If we glance at Lyft's one-year performance, you'll notice that shares are up compared to this time last year, but the gains are modest. This isn't a company that's skyrocketing overnight, but it's also not losing ground. The company's market capitalization sits around $7 billion. What's particularly interesting is that Lyft has a net cash balance on its books. This means the enterprise value, which accounts for debt and cash, comes in at roughly $6.4 billion. Why does this matter? Well, it positions Lyft as a potential value stock. It's not often you see a company that's growing at double-digit rates while also having the financial flexibility to buy back shares. This dual advantage, growth plus share reduction, is what makes Lyft intriguing from an investment perspective, and we'll dig into how this plays out with real numbers shortly. Let's move on to the company's high-level financials. Lyft's gross bookings, the total amount riders spend on the platform, have increased by around 15% compared to last year. That's a solid indicator that people are using the platform more frequently. Speaking of users, Lyft now has 51 million annual riders who collectively took nearly 1 billion rides. That's a massive volume. But here's the standout figure: $1.1 billion in free cash flow. Now, free cash flow can fluctuate quarter to quarter, largely due to factors like insurance reserves. Still, Lyft has firmly entered the territory of positive free cash flow, which is an important milestone for any growth company. Next, let's look at the operational side. Lyft's growth depends on attracting more riders and ensuring they use the platform frequently. One factor that has influenced growth recently is Lyft's acquisition of FreeNow, a European ride-hailing company. This deal contributed to faster growth in active riders, with quarterly numbers showing about 29.2 million active riders, an 18% increase year over year. The acquisition was made using cash, so it didn't dilute existing shareholders, which is another positive point for investors. In terms of ride volume, Lyft experienced an 11% increase year over year. There was a slight dip in the fourth quarter compared to the previous quarter, but that's fairly typical for ride-sharing companies. Q4 is not usually the strongest quarter for growth in this industry. Gross bookings tell another story. They climbed 19% compared to last year, exceeding $5 billion. Revenue for the quarter came in at $1.6 billion. It's worth noting a caveat here. About $200 million of expenses were recorded for legal, tax, and regulatory reserves. This had an impact on reported revenue. Without these adjustments, Lyft's revenue would have been closer to $1.8 billion, a notable increase from $1.55 billion the previous year. So even with these adjustments, Lyft is clearly still growing, both in users and in revenue. Another key metric investors are watching is margins. Lyft's adjusted EBITDA margin is currently around 3%, translating to $154 million in adjusted EBITDA for the quarter. The market has been looking for evidence that Lyft can reach a 4% adjusted EBITDA margin, so this is a step in the right direction. Free cash flow is also moving positively, which reinforces confidence that the company is on a healthy financial trajectory. Looking forward, it's realistic to expect a slower rate of improvement in free cash flow. The $1.1 billion improvement we saw over the past 2 years is unlikely to repeat over the next 2. However, considering that the company's enterprise value is only about $6.4 billion, Lyft is in a strong position to use its cash flow strategically. Much of this cash is being allocated to share buybacks, which we'll explore in more detail next. One of the most notable moves by Lyft's management is the announcement of a $1 billion share repurchase program. The idea here is straightforward. Management believes the stock is undervalued and wants to reduce the number of shares outstanding. At current prices, this buyback could cut the share count by approximately 15%. Lyft already has sufficient cash to execute this program. The company holds around $1.1 billion in cash and short-term investments, with $705 million readily available. This provides ample resources to complete the buyback without taking on additional debt. Of course, an alternative use of this cash could be to pay down about $1 billion of long-term debt, but management appears to be prioritizing shareholder value through buybacks, given the stock's attractive valuation. A challenge for Lyft is stock-based compensation. The company has historically issued a significant amount of stock to employees, which dilutes shareholder value. The figure is currently around $320 million annually, although it has been decreasing over the past 2 years. Reducing stock-based compensation further would improve operating income and make the company even more profitable. This is why Lyft can show operating losses on paper while simultaneously generating positive free cash flow. The difference is largely accounted for by stock-based compensation, making it an important metric to monitor for investors. Looking at Lyft's long-term strategy, autonomous vehicles play a central role. Lyft's approach is similar to Uber's, focusing on partnerships and marketplaces rather than owning the vehicles outright. The company aims to connect fleet operators with riders, acting as a marketplace aggregator. This strategy has a number of advantages. By working with human drivers or fleet operators, Lyft can expand capacity without taking on significant fixed costs. The company's Flex Drive unit is an integral part of this plan, offering infrastructure and support for fleet operators across the U.S. This includes vehicle cleaning, charging, and maintenance, all handled by Lyft, but without Lyft owning the vehicles themselves. In essence, Lyft's marketplace becomes the hub for both riders and providers, positioning the company to capture value as the autonomous vehicle industry grows. From a valuation standpoint, Lyft is trading at roughly 1 times sales and around 6.9 times free cash flow. This is particularly compelling given the potential upside from autonomous vehicles and market expansion. Management has highlighted that this could be a trillion-dollar opportunity, which is staggering when compared to Lyft's current $7 billion market cap. For investors, this represents asymmetric upside. The potential gains far outweigh the downside risk, assuming the company continues executing on its strategy and growth trajectory. Of course, there are risks. Market expectations for adjusted EBITDA and revenue are slightly higher than what Lyft is currently reporting, which can create short-term volatility. Analysts are closely watching growth rates, organic user acquisition, and profit margins. Any minor miss can trigger significant market reactions, as we've seen in other tech and mobility companies. Additionally, uncertainty in the market, regulatory changes, and competition from other ride-sharing services can impact performance. While Lyft is taking steps to mitigate these risks, investors need to remain aware that volatility is inherent in the sector. To sum it all up, Lyft presents a fascinating mix of value and growth. Key takeaways include stock performance, modest gains over the past year but underappreciated by the market given growth metrics. Financial health, $1.1 billion in free cash flow, net cash on the balance sheet, and manageable enterprise value. User growth, 51 million annual riders and nearly 1 billion rides taken, demonstrating strong platform engagement. Revenue and margins. Revenue adjusted for legal and regulatory expenses would have been even higher, and margins are improving steadily. Management actions, $1 billion share buyback program, and disciplined capital allocation. Strategic positioning, autonomous vehicle initiatives, and the Flex Drive unit provide long-term growth opportunities. Valuation, attractive multiples on sales and free cash flow with significant asymmetric upside potential. In short, Lyft isn't just a ride-sharing app. It's a company growing both top line and bottom line, strategically positioning itself for the future and offering investors a combination of value and growth that's rare to find. If you're looking for a company with strong fundamentals, growth in a high-demand market, and smart capital allocation, Lyft is a stock worth watching. That's it for today. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.